Welcome to our latest deep dive. Today we're tearing down Guardian Pharmacy's Q3 earnings. And let me tell you, it was a monster. The company didn't just beat expectations, they absolutely crushed them, and the stock rocketed to an all-time high. So let's get into how they did it and what it all means.
All right, so let's set the stage here. Guardian Pharmacy just dropped a quarter that had Wall Street buzzing, pushing the stock into uncharted territory. But the real story isn't just what they reported. The big question is how they're pulling this off and if this momentum is for real. So let's unpack this thing.
First up, let's talk about the headline numbers. And I gotta say, this wasn't just a slight beat. This was a statement quarter. Guardian came in way over expectations, surprising pretty much everyone, even those who were already bullish on the stock. Okay, so take a look at this. Guardian blew past expectations on both the top and bottom lines. Revenue came in hot at over $377 million, which is a solid 6.5% over what analysts were penciling in. EPS edged out estimates too. But the number that really jumps off the page is the adjusted EBITDA, up a massive 19% from last year. That, my friends, screams operational excellence. And what fueled that incredible EBITDA growth? Well, it's this number right here. Revenue surged a full 20% year over year. I mean, think about that. In this economy, finding a company putting up 20% top-line growth, it's a huge sign that their strategy is just flat out working.
Now, what's so interesting here is how the market reacted. This stock was already having a good year, but these results still managed to catch traders by surprise. You see that pop in after-hours trading, and then, boom, a new all-time high the very next day. That tells you investors aren't seeing this as a fluke. They're seeing it as proof of a powerful, ongoing growth story.
So, the big question is, how did they pull this off? Well, a quarter like this doesn't happen by accident. It's the result of a really clear, really disciplined playbook that Guardian has been executing on for years.
This quote from the CFO, David Morris, honestly says it all. Their whole model is about winning on the local level, but with the power of a national company behind them. They're not some faceless giant. They grow by building real relationships, one community, one pharmacy at a time. And here's the secret sauce. It's this two-pronged attack. On one hand, they grow organically, right? They go out and win new partnerships with care facilities, getting more residents on their service. But at the same time, they're smart about acquisitions, buying up smaller pharmacies to expand their map. The whole goal is to build what they call local density. Basically, they want to own a market, making them the obvious choice and super efficient.
And does that playbook work?
Oh yeah, it works. Just look at this number. Their total resident count jumped 13% over the last year, hitting almost 204,000. It's a really simple formula, but it's so powerful. More residents means more prescriptions, and that flows right to the top line, giving them that huge revenue beat we just talked about.
Listening to the earnings call, you could just feel the confidence from management. CEO Fred Burke's message was unmistakable. This is just the beginning. He's basically telling Wall Street, you think this is good? We're just getting warmed up. That's a signal that they see a very long runway for growth ahead.
And hey, talk is cheap, right? But Guardian is backing up that confidence with cold, hard numbers. They went ahead and raised their full-year forecast, which is exactly what you want to see after a blowout quarter. I mean, look at this. They boosted their outlook across the board. The new guidance is now pointing to around 16% EBITDA growth for the full year. For investors, a guidance raise this big is one of the most bullish signals a company can possibly send. It says, the future looks even better than we thought.
Okay, but it's not all sunshine and roses. To their credit, management was very open about the risks they're facing. The big one is something called PBM reimbursement pressure. Basically, you have these giant middlemen, the pharmacy benefit managers, who are always trying to pay less for drugs. That can squeeze the profits for pharmacies like Guardian, so navigating that pressure is a huge part of the job.
So let's wrap this all up. After digging through the numbers, the strategy, and the outlook, what's the big takeaway for investors? Where does Guardian Pharmacy go from here? Well, here's our call.
We think this momentum keeps going right into Q4. Their recent acquisitions will start adding to the numbers, and a normal vaccine season should give them another tailwind. We're looking for another beat. Now, after this big run, we expect the stock might chill out for a bit, consolidate near these new highs. But the underlying story is just too strong, and we see it breaking out again. For all those reasons, we are initiating our coverage with an outperform rating. And that really brings us to the ultimate question, doesn't it? At the end of the day, it all boils down to this. Guardian is executing flawlessly, but the stock isn't cheap,
and the industry has some very real challenges. The whole debate from here on out is whether this amazing execution is enough to justify a premium price tag, especially with those headwinds swirling.
So there you have it. We love the story, we love the execution, which is why we're calling it an outperform. But that tension between valuation and risk is what every investor is going to have to wrestle with. As always, make sure you do your own homework. This is not financial advice.